The S&P 500 has done something remarkable in 2026. Despite a war in the Middle East, despite inflation running above 3%, despite the Federal Reserve holding interest rates elevated, despite geopolitical uncertainty at levels not seen in decades, the S&P 500 is up. But here's what the headline number doesn't tell you. Beneath the surface of that index, something significant is shifting. The old winners are stumbling. New sectors are quietly taking over. And the investors who are going to do well in the next 12 months are not the ones who simply bought the index and went to sleep. Today, we're going to break down exactly what's happening in the stock market right now, what's overvalued, what's undervalued, where the institutional money is moving, and how you can position yourself intelligently. This is Potentia. Let's get into it. Let's establish the baseline. The S&P 500 ended 2025 at 6,845 points, the third consecutive year of double-digit gains. That's extraordinary. And as of late April 2026, it's trading around 7,140 points, up roughly 4% year to date despite significant macro headwinds. Goldman Sachs is projecting the index could rally an additional 12% from current levels by year-end. FactSet is forecasting 17% earnings growth for S&P 500 companies in 2026 and another 17% in 2027. If those numbers hold, the fundamental case for equities remains intact. But, and this is critical, the index masks enormous dispersion underneath. Some parts of the market are significantly overvalued. Others are trading at multi-year discounts. The difference between owning the right stocks and the wrong stocks in this environment is not a matter of degrees. It's a matter of magnitude. Here's the risk that most investors are not paying enough attention to. For 3 consecutive years, the performance of the S&P 500 has been driven almost entirely by a handful of companies, the so-called Magnificent Seven. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. At their peak, these 7 companies represented more than 30% of the entire index's market capitalization. That level of concentration hasn't been seen since the dot-com bubble of the late 1990s. And you know how that ended. Now, Goldman Sachs is calling this the beginning of a marathon broadening, a shift away from narrow megacap tech leadership toward the other 493 companies in the index that have lagged for 2 years and are now trading at significant discounts to their historical valuations. Cyclical stocks, industrials, energy companies, financial sector, healthcare. These areas of the market have underperformed megacap tech dramatically, and they are now attractively valued relative to their earnings power. The investors who are going to outperform in 2026 are not the ones buying the same stocks that already tripled. They're the ones moving into the areas of the market that got left behind. So where exactly is the institutional money going? Let's be specific. Energy sector. The war in Iran has sent oil to $100 per barrel. Energy companies are generating record cash flows. Many are buying back shares and paying substantial dividends. The sector has dramatically outperformed the broader market in 2026 and still trades at a discount to the S&P 500 on a price-to-earnings basis. Defense and aerospace. Geopolitical instability drives defense spending. NATO members are increasing their military budgets. The major defense contractors have multi-year order backlogs and government contracts that provide extraordinary revenue visibility. This is one of the clearest structural investment themes of the decade. Financial sector. Banks benefit from elevated interest rates. Their net interest margins expand when rates are high. With the Fed keeping rates elevated through at least mid-2026, the financial sector is positioned to generate strong earnings. International equities. This is perhaps the most overlooked opportunity in 2026. European stocks are trading at roughly a 30% discount to their American counterparts on a price-to-earnings basis. Emerging market equities are even cheaper. For investors who are willing to look beyond U.S. borders, the value proposition is compelling. Dividend-paying value stocks. In an uncertain environment, companies that pay reliable and growing dividends, and that trade at reasonable valuations, provide both income and downside protection. The Dividend Aristocrats Index, companies that have raised their dividends for 25 or more consecutive years, is worth serious attention right now. The S&P 500 is not one thing. It is 500 companies operating in dozens of industries with wildly different risk profiles and growth prospects. The investors who treat it as one monolithic bet and simply buy the index and forget it will do fine over the long term. But the investors who understand what's happening beneath the surface, who are deliberately rotating into the areas of the market that are undervalued and underowned right now, those are the ones who will look back on 2026 as a significant moment in their wealth-building journey. This is Potentia. In the next video, oil, energy, and the geopolitical shock that's reshaping investment opportunities across the globe. Don't miss it. Until next time.